You're listening to a CNA podcast.
Hey there, it's Andrea Heng. Thank you so much for listening to the Money Talks podcast. This is where we discuss everything there is to know about personal finance, just in case you didn't already know that. Now, before we begin, I have a little request to make. Could you please follow us on Spotify, Apple Podcasts, and YouTube Music? This is so that you can be notified every time a new episode drops. Now, first, some quick financial headlines that I wanted to bring to you, starting with some manpower news. Now, we saw the latest labor report showing that 30% of firms plan to increase wages. So big yay! 48% of those polled in that report say that they are hiring as well. So it looks like a good picture in the labor landscape. MOM basically follows the Ministry of Trade and Industry's forecast, which, if you don't already know, is showing good growth prospects for Singapore this year. But there's always a caveat. We're still hearing of people being retrenched and companies undergoing restructuring. So if you are getting a raise, make sure you set aside most of it to be reinvested, okay? Just in case of a rainy day. That's the advice we are always giving to you that we get from our guests as well. So make sure that you make use of that, okay? And you know what? If you find yourself in the unfortunate situation of being retrenched, I feel you. I've been there, but we have an episode for you that you might find useful. Just look it up on Spotify or Apple. All right, on to the next news nugget. If you are one of those who have properties to rent for income, you might want to know that condo or private property rents have fallen. But HDB rents, on the other hand, have come up to an all-time high. This is all based on flash data from SRX and 99.co. Experts are saying that the increased number of homes available is a factor in lower condo rent. And speaking of condos, Lentor Mansion, Guocoland's latest high-end development, they recently sold 75% of its 533 units. The Thomson East Coast Line has the Lentor station. That's very near where this development is. And they're not the only ones. Several other developments have popped up around the area. It just goes to show that property will remain the surest, well, one of the surest investment options that we can gun for. All right, let's get cracking to our main topic. Hi, I'm Andrea Heng. Welcome to the Money Talks podcast. So often when we think about investing in stocks on the S&P 500 or ETFs, if that's your thing, we usually refer to something that's already widely known, right? That's because they're traded in the public domain, like the Singapore Exchange, the New York Stock Exchange, or the London Stock Exchange. These are the big ones out there, right? But I've often wondered if we could look elsewhere. Well, elsewhere exists in the form of private markets. If you've never heard of them, then you'll be comforted to know that today it's also a completely new territory for me. So let's find out together, shall we? Today we have the generous help of Michele Ferrario. He is the co-founder and CEO of investment service firm StashAway. Welcome to the Money Talks podcast.
Thank you for having me.
So first and foremost, give us an overview of what a private market is. How exactly does a private market differ from what we already know out there, the public market, right? The SGX, NYSE.
Yep. I mean, put it very simple. If you are buying a stock on a public market, you're buying Apple shares on a New York Stock Exchange, DBS shares on the SGX, you can buy it when the markets are open. Anybody can buy it at any time when the markets are open for a price that is public. Like,
Right.
you can actually check the price right now on a bunch of services, from sophisticated services like Bloomberg to Google.
Right.
It's very open. It's public.
Yeah, and that's what an IPO is for, right?
Yeah, when your company goes public, when you do an initial public offer, so
Right.
IPO, and that's when a company goes public. So it goes from being private to being public, and so
Right.
and it becomes possible for anybody to start buying and selling the shares of the stock. While the day before the IPO, it'd be very challenging to buy and sell the shares.
That's right.
For instance, StashAway is a private company. If you want to buy share in StashAway, is actually complex. It's not something you can do by yourself.
Right.
It will require a very complex and potentially costly process
Okay.
to buy shares or invest in the shares of StashAway as an example of a private company. While buying a public stock you can do it anytime, you can do it with a price that is kind of clearly stated and driven by...
Everything's transparent.
Everything is transparent. On the private side, that doesn't happen. And these are private transactions which tend to require more time and are privately negotiated.
Right.
And for instance, let's say you want to invest in a private company. What you need to do is you need to talk to the company or to the shareholders of this company, and there will need to be a transaction where every party involved agrees. There's probably going to be documents to be signed, shareholder agreements to be signed. And so that's a long process.
Wow.
But it is a process. Let's not forget the great majority of companies are private.
Exactly. And that's a great point that you brought up, because everyone thinks, the ones that are publicly traded are the ones that you need to know, and that's it. Actually, a larger percentage, most of them, like you said, are in the private sector, in the private markets. How would an investor like myself go about choosing to invest in private markets? How do I make that choice?
Yeah, so first of all, let me make a slight step back. So private markets is not just private equities. So we gave it as an example stocks and private equity, but in reality, you also have private credit, which is the equivalent of bonds in the public world.
Right.
You actually have private real estate funds, and then the list goes on and on.
Okay.
But let's maybe focus on equities and credit as
Sure.
kind of the two kind of bigger, more important asset classes. So how do you go about it, and why would you want to invest in private markets?
Yeah.
So private markets tends to be a place to diversify further your portfolio if you have a certain level of wealth. I don't think, and the regulator doesn't think, that it's for everyone. Meaning that in Singapore, for example, to get access to private markets, you usually need to be an accredited investor, which means you need to have either an income north of 300,000 Singapore dollars a year or personal financial wealth north of $1 million Singapore dollars.
Right.
And that's because those are complex products. They have some features like illiquidity. We can talk about it in a second. That makes it important for people to fully understand the details of what you are getting yourself into. But if you are an accredited investor, you have a few $1 million in your personal financial wealth, then actually private markets offers a way to increase the diversification of your overall portfolio, improving returns overall, while potentially reducing risks, which is exactly kind of what you want to do with any portfolios.
Oh, interesting. And you talked about illiquidity as well. Walk me through that. You're saying that if we invest in a privately traded company, there is that fixed movement, there's lack of movement, there's lack of liquidity.
Yeah, when we gave the example earlier of how more difficult it is to invest in a private company versus to invest in a public company, the same happens if you want to divest, if you want to sell.
Yes.
So you're now a shareholder of a private company and you want to sell. It's not like when you are a shareholder of a public company where you go on your brokerage platform and you just click sell and somebody's buying it. You don't even know who is it, right?
Yes.
On a private transaction, you actually need to know someone that wants to buy from you, and you need to discuss the price.
Wow.
Look, it's very similar to when you buy and sell an apartment.
Oh, yeah.
At the end of the game, buying an apartment is an investment in private real estate. So you could argue it's part of the same logic.
Yeah.
And when you sell it, it's not like you click somewhere and the apartment is sold.
Exactly.
Like, you need an agent that will find you a buyer, and then you need to discuss whether, in fact, you agree on a price. And then there is a process. Maybe you need to go to the notary, depending on the country, and you need to pay stamp duty. And so there is a lot of complexities in the process. The same is, or even more complex, I would argue, the same is for, in general, private holdings. So what usually happens when you invest in private markets, you invest through funds. So you invest in a private equity fund.
I see.
You invest in a private credit fund. And so there is a team of people whose job is to manage these processes.
Right.
And this is obviously a more costly process.
Of course.
But it can be justified by the excess returns that these asset classes can provide if managed correctly.
I wanted to ask about the other benefit to investing in the private markets. Does it just boil down to yields? I mean, what kind of yields would investing in the private markets give me that I can't get from the public markets?
Okay, I'll give you some broad range numbers. When you look at equities, let's call it the S&P 500 over long period of time does on average, anywhere between 8 and 10% per annum.
Yeah.
When you take a long enough period, and of course, in any given year, it can lose
Of course.
20%. But
Yeah.
if you give it enough time, over time, it'll return anywhere between 8 and 10% per annum. Private markets, on average, or the medians, private equities actually, they are somewhere north of 15%.
Oh.
15, 16 on average. What
Right.
that net. So what that means is that you have 5, 6 percentage points of extra returns that you can aim for. Now, obviously, that because while in the public markets you can invest in the market, you can
Yes.
buy an ETF on the S&P 500.
That's right.
What, that's how StashAway builds the portfolios. We buy the market, we buy the index, and you are diversifying very much,
Right.
and you are getting over time. You're going to get these 8, 9, 10%. That's going to happen. On private markets, because of the complexity we discussed, you're going to invest in a fund.
Yes.
And so you need to make sure that fund performs as expected. And the diversity of performance between the top quartile funds or the best funds and the bottom quartile funds or the worst performing funds can actually be quite significant. And the performance changes by vintages. So, the 2017
Right.
private equity vintage will have a different performance than a 2015 private equity vintage, and that depends on the macroeconomic environment through their investment period, for
Right.
instance. As I mentioned, the fund managers, obviously geographies matter. If you invest in China versus the US versus Europe, etc., you might have in different times
Sure.
different returns. And obviously sectors, if you invest in technology versus
Yeah.
industrial versus consumer goods, that would change. So at the end of the game, the answer is that even in private markets, you want to diversify.
Yes, of
And
course.
you want to diversify across vintages. So you don't want to invest all of your private equity allocation in 1 year. You want to diversify across managers, very importantly.
Okay.
So you don't want to invest, I'm not going to name names, but you don't want to invest in one
Of
manager
course.
only.
Yeah. You don't want to put all your eggs in one basket,
Correct.
basically.
I'm talking about private equity.
Yeah.
You want to diversify across geographies. You want to diversify across strategies or sectors, which go hand in hand with the fund manager selection. It has been historically very difficult to do. And so the only people that could actually do it were institutions.
Right.
So when you look at where, GIC
Yes.
or Temasek invest or the Harvard Endowment invest, they do this.
Right.
They have a significant part of their portfolio allocated to private equity or private markets in general, but now I'm focusing on private equity for a second. And what they do is they invest across a vast number of managers. They invest continuously, so vintage after vintage, across the world, and they diversify this way. But because of why was it difficult or why it is difficult for individual investors? Because usually minimum ticket sizes are very large.
Right.
So if you go and give a call to a private equity fund manager, they'll tell you, look, minimum ticket size is $5 million. If you then go to a bank, to a private bank, they usually will tell you minimum ticket size for a specific private equity will be anywhere between $150,000 and $250,000.
Okay.
So if you have, say, $3 million and you want to have 10% of your portfolio in private equity,
Right.
so you have a budget of $300,000. You want to do it across vintages, let's say 4. So $300,000 divided by 4, that's $75,000 a year.
Yeah.
You go to your private bank and your bank tells you, oh, minimum ticket is 150. Even if the minimum ticket was 75, you would be able to make one investment.
Yes.
That's not a diversified portfolio.
Yeah, exactly.
And so that's exactly why it's complex for
Right.
people that have less than 20, 30, $40 million, which is a lot of us.
It is. I would say even the majority of us, I would argue.
Probably you're right. It's 99.9 something percent. But anyway, jokes aside.
Yeah.
So for the great majority of people, this becomes inaccessible. And that's what we try to do. The problem we've been trying to solve is exactly this. How do we make it possible for somebody that has as little as a couple of $1 million and up to 10, 15, $20 million, how do we make it possible to do the same thing that Harvard Endowment, GSE, and Temasek are able to do?
Right. It's basically democratizing the access to private markets, right?
Correct. I mean, democratize it to a certain level because obviously these remains a product that is a diversification strategy that makes sense only if you have a certain level of assets. And this is for private equity. Now, let's not forget there is a credit part, right? Traditionally, people think about portfolios in 60-40, 60% equities, 40% bonds, etc.
Yes.
Okay, you can actually think about it as part of your equity allocation, as part of your bonds allocation. You might want also some private allocation.
Okay.
If you are, again, if you have a certain level of wealth. On a private credit side, you have some of the same features where maybe the vintages diversification is perhaps less important. It's very important, again, to look at fund manager selection. And it's incredibly important to understand where are you investing, meaning that private credit strategies can be very different from each other. Are you investing in the riskier side of private credit? Are you investing in the less risky side of private credit?
Like you said, for the longest time, only accredited investors could invest in the private market, but now there's a shift. So take us through that shift.
Look, let's first take the market's perspective. Like you are a private equity fund manager. All of your investors historically have been institutions, a Harvard Endowment, a GIC, and, the sovereign wealth fund across the world, et cetera, et cetera. And just to give you some numbers, on average, endowments have north of 30% of their overall portfolio allocated to private markets. So that's been where the sources of capital for private equity and private credit has been over the course of the last few decades. Over time, family offices, the people with not as large pools of money have started to get access. So family office, maybe with $100, $200, $500 million, starting to allocate a portion of their capital to private markets. And over time, there has been an interest of trying to also make it available for people that have between 50 and 100 million, and then between 20 and 50. And then there is players like StashAway that actually are trying to bring this level of diversification to people that are in the $1 to $20 million range. I think, as I mentioned, below 1 million, first of all, regulation is tricky. But secondly, I think there is an illiquidity issue that needs to be taken into consideration.
Yeah.
And so that's why our focus for the private markets is on the $1 to $20 million wealth. I'll tell you my personal story. I'm in this segment where until a few years ago, I had no private equity or private credit exposure because it was impossible. All of my money is in StashAway portfolios, diversified, the classic ETF portfolio, liquid, etc. That's where my savings are. But now, players like StashAway made it possible for people like me to have a portion of their wealth in these instruments. I'm targeting getting to around 10% exposure to private markets. I said I'm targeting because it takes time. As I mentioned earlier, you want to diversify through vintages, right?
Yes.
I haven't put all the money immediately. I actually have a plan over 4 years to get there. Now I've been doing this for a couple of years, so now I'm halfway through the plan.
All right. I wanted to talk more about the kinds of companies that are on private markets. You explained a little bit about them, how to identify them, why they are there. I'm curious about that part about vintages. Could you just walk me through that? What are these things called vintages in the private market?
Let's remember that when you look into private markets, different pockets of that behave very differently. Let's talk for a second about private equity. When you invest in private companies, usually private equity holds their company for anywhere between 3 to 7 years.
Okay.
And so obviously, if your holding period is through great times from an economic perspective, there is a higher probability that during these 3 to 7 years, the company you've invested in are going to do well.
Yeah.
If kind of economic cycles play against you, and so you buy the company just before a market crash, and maybe there is 2-3 difficult years,
right.
Probably you're going to hold the companies for longer because you're going to try to
recover. You're going to wait for the wave to come back up.
Exactly. And that might affect returns. And so that's why different vintages show some difference in returns.
Right.
And that's why diversifying across vintages is important, because you want to play across the macro cycles over time. Now, to be fair, when you invest let's say you invest in or you commit money to a 2024 private equity vintage, it doesn't mean that you're investing 100% of your money committed in 2024. The fund will actually take usually 5 years to invest the money, or up to 5 years to invest the money.
It's kind of like a maturity period, right?
Correct. Usually there is an investment period, and the fund has time because they need to go out and look for companies, right?
Of course,
they don't have all the companies lined up.
Exactly.
And that takes time, and they want to do it over time. Also, so there is some time diversification even within one single vintage, just because you're going to invest across 4 or 5 years. But still, looking back, different vintages have different returns. So again, as an investor, what you want to do, you want to create a program where you invest on a yearly basis part of your wealth so that you get to the right exposure. Now, if you look at what the most sophisticated investors in the world do, because they've been running private equity programs for a long time, these programs are kind of self-funded. If you commit for 5 years or 6 years in a row to a private equity as an asset class, after 4 or 5 years, you're going to start to receive returns.
Right.
from the first funds you've invested in, right?
Mm-hmm.
And so then you can start investing those returns in new commitments. And so that's what the large investors do, right? So you have a kind of a recycling of the money that comes in.
Like rolling over your profits.
Correct, exactly,
Yeah,
correct.
okay.
And you continue to increase your program, or you can keep it constant. And that's what the large institutional investors do.
Are private markets regulated? I believe they are. Who regulates them?
Most investments are in a way regulated, meaning that in Singapore, the MES is the regulator for everything.
Right.
And so access to private markets are regulated. As I mentioned earlier, they're actually restricted to accredited investors.
Yes, there are certainly some risks that investing in private markets will pose to investors, particularly because, as you said, there isn't quite a platform where in the public domain, when we're investing in our ETFs on the S&P 500, for example, there are platforms like yourselves, right? Anyone can access these transactions. You either have to find a fund manager or, like you said, do this complicated process of knowing someone within the organization, within the market, to be able to trade or invest in. Are there any risks that investors need to be aware of when looking at the private markets?
Yes, obviously. You mentioned liquidity risk, so the ability or inability to sell.
Yeah.
Now, the example we gave earlier is when you go direct and buy, invest in a company. Now, what most people and even institutional investors will do is invest in a fund.
All right.
And so that's an issue that is managed by the fund. So
Okay,
as an investor, your liquidity risk is not inability to sell a company, because that's a fund's problem. Is inability to sell the fund shares if you want to get out.
Right.
And so that you actually need to wait for the funds to sell all of their companies to get the money back. There is a secondary market where you can buy and sell units of a fund in practice, but those are yet not developed.
Right.
And still costlier than investing in kind of then trading on a public market.
Forgive me, it almost sounds as if it's a black market of sorts.
I mean, it's the same thing as we gave the example earlier. You want to sell your apartment, that's a secondary market. Maybe you bought an apartment that was new.
Yeah.
And now you're going to sell it to somebody who's not new anymore.
So it's a resale market.
Exactly. It is. It is. That's what a secondary market is.
Right. So just a final question here. What are some of the emerging industries that private market investors, especially new ones, should be looking into?
From a private markets perspective, private markets invest pretty much everywhere.
Yeah.
So there is obviously private equity. We talked a little bit of private credit, but there is infrastructure. So there is a lot of private money going into building airports or hospitals or roads or whatever. And so most companies are private. And so there is a pool of potential opportunities out there. Now, the biggest trend that is happening in the industry is actually what you called the democratization of access.
Right.
So what we are doing at StashAway of making it possible for people that do not have $50 million to actually get access to pockets of this asset class and ideally doing it in the right way. So with the right diversity. So this is probably the biggest change that is been happening and is happening in the industry. In sync with this, there is new ways of building products. And so we talked about how to build diversified private equity portfolios. That's kind of what we do at StashAway. But also in the industry, there is now semi-liquid private credit portfolios. And so that reduces the liquidity issue on the credit side of things. And as I mentioned earlier, that's what we offer as well, because it does make it easier to access. And therefore it enables, again, people that might have $1, $2, $3, $4 million to actually get access to an asset class that does complete a portfolio.
Do you think that there will be a day where investors with not $1 million, maybe 500,000, 50,000, do you think there will come a day where these kinds of investors could perhaps pay a visit, have dipped their toes in the private market?
The biggest issue is liquidity. I mean, forget regulation for a second.
Sure.
Which obviously plays a role. The main issue is liquidity, especially in private equity. Investment in a private equity fund can be illiquid for years.
Yeah.
We will be working on creating opportunity for liquidity, early liquidity for people. And so that might actually enable people that have maybe less of a large portfolio to get access. But to be fair, in order to reap the full benefits of investing in this asset class, you need to be patient.
Oh, of
and
course,
so you need to, so that the liquidity is, we could argue, is a problem, but it's also a feature in a way. It's
exactly.
Why does private equity tends to return higher than public markets? Also because of that it's patient capital, right? That doesn't get priced, that can actually wait through cycles. And can, it doesn't have to show quarterly turns, and so that CEOs can make different decisions that might actually create more value in a few years' time because there is a bit more patience behind it. They can, build different capital structures. So there is a number of reasons why that liquidity actually helps. But to answer your question, I think that's maybe the biggest hurdle to people with less funds to get access.
But you know what? The trade-offs, I think, are quite fair, considering how, private markets have operated all this time. Michele, thank you so much for demystifying private markets to me. Today's lesson has been opening up a new world of investing for us. So thank you very much.
Thank you for having me.
And thanks to you as well, listener. What did you learn about private markets today? Will you be looking at them after this conversation? Let us know in the comment section, okay? You can chat with us on Apple Podcasts, Google Podcasts, Spotify, YouTube Music as well. We are all over the shop, so you can reach us anytime, anywhere. We'll be looking out for your comments. And if you really like what you've been hearing here on the Money Talks podcast, rate us on that platform as well, okay? Thanks as well to the Money Talks team. They are made up of Joanne Chan, Tiffany Ang, Crispina Robert, Junaini Johari, Sa Ye Wint. I am your host, Andrea Hing. Thank you so much.